So everyone keeps calling Geelong Victoria's next boom city, but what if the data says otherwise? Over the past few years, migration out of Melbourne has surged, Geelong's vacancy rates have been below 1%, and prices have soared. So on paper, it looks like the perfect success story. But here's the truth. Geelong's growth engine is shifting. The data shows us that it's moving from boom to balance. And if you're expecting another explosive upswing, well, you'll likely be disappointed. Because whilst demand is strong, yields are still sitting between 3 to 3.5%. And a lot of so-called blue chip suburbs have already delivered 6 to 7% annual growth across the last 10 years, which is basically the national average. So instead of asking, can Geelong boom again? The smarter question is, where can it still quietly outperform while the rest tracks sideways? And that's exactly what I'm going to show you in this video. Which suburbs have already run hard, which ones are lagging and have catch-up potential, and how to separate the hype from genuine data signals. And once you see how the affordability squeeze and population growth overlap, you'll understand why Geelong is not built for hype, it's built for consistency. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit that like button. And just a quick heads up, the data tells me that over 90% of the people who watch my videos are not subscribed. So if you find this video useful, make sure you subscribe so you can see more data-driven breakdowns just like this. And with that said, let's jump into Geelong 101 and affordability. So for those of you who aren't familiar with Geelong, it's located 75 kilometers southwest of Melbourne. It's got a population of 270,000 people. So it's a fairly large regional city here in Victoria. It's got a strong and diverse economy comprised of healthcare, education, manufacturing, and it's also got a significant port presence. From an affordability perspective, its median house price sits in the mid 700s and its median household income sits between 90 to 100K. And from a price to income ratio, it sits between 7 to 8 times, which is definitely on the upper end of where I'd typically be looking at when considering a market from an investment perspective. What about population growth? Well, from a future forecast perspective, so from 2021 to 2046, forecasts show Geelong growing by 171,000 people, or 63%, with an average annual rate of just under 2% per annum to 442,000 by 2046. A more recent 2025 forecast by CBRE Australia says Geelong will add 86,000 people by 2034 alone, showing a strong near-term push in its population. So what are the key takeaways from that? Well, Geelong's future population growth rate of around 2% is solid and well above many metro suburbs, which is a positive for its demand. But compared to other major capital cities or breakout regional hotspots, the scale is still relatively modest. The baseline population is lower and the growth pipeline, while healthy, isn't at explosive levels. And this means that Geelong is likely in store for steady performance rather than a rapid spike. And the affordability advantage that you used to have is absolutely narrowing, which suggests that there's less room for runaway growth. But the upside comes from stability and lifestyle appeal. But to really understand what that actually means, you've got to see how these numbers translate into real market behavior. And here are the key market metrics. Firstly, let's touch on its 10-year growth rate. So some suburbs in Geelong are hovering between a growth rate of 6 to 8% per annum. And those have already run hard, in line with the national average. But others are sitting at between 3 to 4% per annum. So they're lagging, and they definitely have a level of catch-up potential. So it's definitely not a market that you can throw a dart on a map and just invest anywhere. You need to be selective and data driven. Secondly, from a yield perspective, houses are offering approximately a 3.5% yield at this current point in Geelong's market, which is stronger than some pockets of Melbourne, but still far from some of the stronger yields that we're seeing at the moment in other capital cities and certainly other regional towns. Vacancy rates, on the other hand, are under 1% in many family-owned areas, and that shows us that there's super tight rental conditions on the ground, which are likely placing upwards pressure on rents across the short and medium term. Lastly, stock on market is extremely scarce at under 1%, which shows us that there's high scarcity in established suburbs, but you still need to be cautious of potential oversupply, particularly in the outer estates. And this is why Geelong is such a steady market. Its supply and demand dynamics tend to balance out. Some suburbs might lead while others lag behind, and overall, the city has tended to track towards the national average, rather than having wild swings across shorter periods. But the suburbs that have lagged the hardest are often the ones where the opportunities quietly land. So with that said, here is the criteria that I used to build out my top 5 list. Firstly, I've focused on mean reversion potential, so suburbs with lagging 10-year growth rates. Secondly, I've focused on suburbs with higher yield percentages to help insulate against those higher interest rates we're having at the moment. Thirdly, I've focused on scarcity, so suburbs with low stock and strong owner-occupied demand. And secondly, I've completely avoided the oversupplied fringe estate areas where there's plenty of house and land packages. And remember, supply is the enemy of capital growth. But remember guys, data alone doesn't tell us the full story. Just because an area has strong fundamentals, it doesn't mean that it is automatically a good investment. Qualitative factors, they matter too. Things like crime, lifestyle appeal, and livability. At the end of the day, it's people who drive markets, not spreadsheets. And as always, everyone's individual circumstances are different, so be sure to always seek out personalized, independent advice before making any investment decision. So with the framework aside, let's look at the suburbs themselves. And the first one is Newtown. And before you get shocked, I want to explain to you why I've placed Newtown on the list. So I see it as the benchmark ceiling for Geelong. It shows you where that top end sits. It's got high prices, relatively low yields, it's safe, but it's capped out. And everything else in Geelong tends to re-rate against it. So although it's number 1 on the list, I've more so included it as a benchmark as opposed to the one that I would absolutely be piling into at this point in the cycle. Let's jump into the stats. So its median value is 1.2 million, relatively high. The yield's only at 2.7%. So you've got to have really strong cash buffers to get into an area like Newtown. That said, its vacancy rate is just 1.4%. So there's a lot of pressure on rents at the moment. Days on market, pretty stretched at 58 days. But you can tell based on the renter proportion at just 28%, this is definitely an owner-occupier heavy market, which is definitely what I like to see before considering a suburb for its investment potential. Stock on market, 1.64%. And lastly, its 10-year growth rate sits at 7%, so it's already performing at the national mean. So I wouldn't expect any outperformance across the short and medium term. So if Newtown is the ceiling, wait until you see what happens lower down the ladder, where affordability starts to take control. But before I reveal that, if you're looking at property and not just in Geelong, I've put together a completely free asset due diligence checklist. It's not some fancy investment guide. It just lists a lot of the basics that I look at, including things like red flags, zoning, tenant demand, before looking at any investment decision. If you're interested at all, check that out. The link's in the description box down below. And just before I jump into the next suburb, a quick note, one of the suburbs that I'm going to show you later, it's barely moved in years, and the data says that it might be next in line for re-rating. So stick around so you can see which suburb that is. With that said, let's jump onto the second one on the list. It's a more affordable market, it's Belmont. Belmont is the middle market benchmark. It tells you what typical Geelong looks like. Steady demand, no big surprises, but it's not an alpha market either. It's got a median price of just 744K, so definitely more on the entry level side. Yields are stronger at 3.7%. Vacancy rate of just 0.9%. So very tight vacancy rate. And again, the lower the vacancy rate, the more upwards pressure that I would expect on yields in the short to medium term as rental growth accelerates. But at the same time, its growth rate is at 7%. So again, it's been performing at the national growth rate across the last 10 years, which means that outperformance over the next short to medium term is probably not too likely. That said, days on market sits at about 33 days, so I wouldn't say it's very hot, but it's definitely not as cold as Newtown either. I would expect steady price pressure on the ground at the moment. Renter proportion sits at 34%, so definitely a heavy owner-occupier market, not as concentrated as Newtown, but still relatively up there, which is a positive. And lastly, stock on market at just 0.97%. So there's pretty much no stock available on the market in Belmont at the moment. So to summarize, it's a steady performer, it's well located, close to Geelong CBD, and one to definitely consider if you're looking at Geelong at the moment. And guys, remember, this isn't an exhaustive list. There are definitely more attractive suburbs in Geelong than the 5 I've pulled out in this video. So I'm curious, if you were investing into Geelong today, which suburb would you be looking at? Drop it in the comment section down below and I'll look to respond to all the comments that come in. And if Belmont is steady, what about a quieter suburb that hasn't had its run just yet? Well, that suburb is Thomson. Firstly, why is it on the list? Well, Thomson, it's been that quiet achiever. It's got a lagging growth rate across the last 10 years of just 4.5%, so it's underperformed the broader Geelong market and the broader national market. And that lagging growth rate suggests that it's got mean reversion potential. If you want steadier upside, this is where the data points for Thomson. On top of that, it's got a more attractive yield of 4.3% according to the REIV. Vacancy rates of just 0.5%, so there's even more upwards pressure on rents across the short to medium term. Days on market, just 31, so it's the hottest of the 3 markets that I've listed so far. But there's something to keep an eye out for, and that's the renter proportion, which sits at 51%, and that's pretty high. Now you might be wondering, why do I get concerned with a high renter proportion? Well, things always slow down at some point, and the last thing you want to be doing is leasing your property into a market where you're competing against a bunch of other investors. And when a suburb has 50% rental stock, there's a lot of investors in that market, and that's competition that you don't want. So that's something definitely to be conscious of prior to looking at Thomson as a suburb to invest in. So the things I like about it, it's underperformed over the last decade. It's got tight vacancy rates, which indicates latent demand in rents across the short term. It's at an accessible price point for families at just 700K. And lastly, it's been a quiet achiever, which means that it's not on most people's radars just yet. So if Thomson is under the radar, what about a bigger suburb with the same lag story? Well, that's Grovedale. Grovedale's got a median price of just 732K, a yield of 4%, which is relatively healthy. Vacancy rates just 0.9%, incredibly low. Days on market, and this is the lowest we've touched on so far, at just 26 days. That's a pretty heated market now. Renter proportion, I really like that at just 26%. Barely any stock on market at just 0.74%. And a 10-year growth rate of 4%. So again, it's lagged the national growth rate, which is a positive sign in terms of its likelihood of outperformance across the short and medium term. I also am a fan of its location. It's close to Deakin University, close to transport, so it's definitely got fundamentals from an amenity perspective. So why is Grovedale on the list? Well, it's the textbook mean reversion play. Don't expect a boom, but it's definitely got catch-up growth to play out. Now, with Grovedale out of the way, here's where it's worth contrasting Geelong with Melbourne. Melbourne's sitting earlier in its recovery phase. Sales volumes are rising, vendor discounts are tightening, and rental vacancies are drifting lower. It's not booming yet, but these are the same early cycle signals that tend to show up just before the wider upswing. Geelong, by comparison, is steady and balanced, slower moving but consistent. If you want to see exactly what data points I'm tracking to confirm Melbourne's rebound and how to spot the moment it actually starts moving again, make sure you watch my Melbourne 2026 video right after this one. I'll link it on screen and in the description box down below. So if Melbourne is beginning to pick up and Geelong is steady, what about a suburb that's still transitioning and being re-rated as we speak? Well, that's the last one on the list, and it's Newcombe. Newcombe is the most affordable out of the suburbs that I'm going to speak about today. It's got a median value of just $622K, a healthy yield of 4.3%, super tight vacancy rates of 0.7%, and a 10-year growth rate of 4% per annum. Its days on market are pretty warm at just 30 days, and it's got a renter proportion of 39%. Stock on market is super tight at just 0.81%. Newcombe's appeal is its affordability and proximity, about 3 kilometers east of the Geelong CBD, but land dynamics here are fairly mixed. To the north and northeast around Breakwater, East Geelong, there is some remaining infill and vacant land, mostly low density residential lots or light industrial parcels that could be repurposed. However, the major greenfield expansion fronts for Greater Geelong, areas like Armstrong Creek, Lara, and Lovely Banks, are well outside Newcombe's catchment areas. And that means Newcombe's immediate supply pipeline is finite and incremental. It's not large enough to cap price pressure once demand does pick up. Over time, the suburb's CBD proximity, older housing stock, and renovation activity position it for gradual re-rating rather than a speculative boom. It's definitely a transition market, still affordable, still overlooked, but slowly tightening as inner Geelong pushes outwards. So there you have it, Newtown, Belmont, Thomson, Grovedale, and Newcombe. 5 suburbs that show what Geelong truly is, a steady market, not a boom market. If you're chasing stability and consistency, Geelong probably makes sense. But if you're chasing explosive growth, you'll probably find better bets elsewhere in Australia. Perth, for example, is running significantly hotter with a sharper supply-demand imbalance. And guys, just remember, I'm a random guy on the internet who looks at data behind property. Make sure you get your own independent advice before making any investment decision. And thanks so much for sticking around. I really appreciate your time and I hope you got value out of this breakdown. And if it helped you, make sure you hit the like button and subscribe. It helps more people see data-driven content just like this. And with that said, I'll see you in the next one.